At this precise moment, Tilray Brands Inc., trading under the ticker symbol TLRY, is exchanging hands at $7.32, showing a modest intraday gain of 10 cents or approximately 1.39%. On the surface, seeing a stock in the green, trading firmly above the $7 mark, might suggest stability, perhaps even a sign of strength, in a sector that has been battered by regulatory headwinds for years. If you are just tuning in or glancing at your portfolio app, your expectation might be that Tilray has finally found its footing, that the lifestyle brand pivot is working, and that the long-awaited cannabis recovery is underway. You might see that green number and think, okay, the bottom is in. That is the expectation. The reality, however, is a masterclass in financial engineering and optical illusions. The reality is that this $7 price tag is not a result of organic growth or explosive demand for pot-infused seltzers. It is the direct aftermath of a brutal 1-for-10 reverse stock split that executed just days ago. Without this maneuver, Tilray would be trading in the penny stock gutter, likely below 80 cents, battling for its life against Nasdaq delisting notices. We are not looking at a recovery rally today. We are looking at a company that has just performed emergency surgery on its own share structure to stay in the game, and the market is still trying to figure out if the patient will survive the procedure. When you see that plus 1.39% on the screen, you have to contextualize it within the violence of the last 2 weeks. The volume we are seeing today, hovering around the 3 million share mark, is deceptive because the float has been decimated. There are 90% fewer shares in existence than there were last month. This scarcity can create erratic price action, where small buy orders push the stock up disproportionately. But do not mistake this volatility for conviction. The institutional money, the big funds managing Fidelity wealth management accounts or running automated strategies on interactive brokers' trading platforms, know exactly what a reverse split signals. Historically, companies that reverse split do so from a position of weakness, not strength. It is the Hail Mary pass of corporate finance. The expectation from the retail crowd, often fueled by hope and nostalgia for the 2018 bull run, is that a lower share count will help the stock move faster to the upside. The reality is that it often just gives short sellers a higher price point from which to attack again. This is the tension defining the trade right now, the optical illusion of a higher price versus the fundamental reality of a business that is still burning cash in a legislative environment that just turned hostile. Let's go deep into that legislative environment, because while everyone was watching the stock split, a legislative bomb went off in Washington that fundamentally alters the thesis for Tilray's U.S. expansion. I am talking about the Farm Bill and the specific crackdown on hemp-derived cannabinoids. For the last 2 years, the loophole economy, selling Delta-8 and hemp-derived Delta-9 drinks in states where marijuana is illegal, was the secret growth engine. It was the backdoor into the U.S. market. The expectation was that Tilray, with its massive beverage infrastructure, Sweetwater, Montauk, etc., would flood the zone with these hemp drinks and capture millions of consumers before federal legalization even happened. That was the bull case. The reality is that the new provisions in the 2025 Farm Bill, specifically H.R. 5371, have slammed that door shut. Congress has closed the loophole. By redefining hemp to include total THC, both THCA and Delta-9, and capping it at negligible levels, they have effectively banned the very products that were supposed to bridge the gap to legalization. This is a catastrophic blow to the U.S. optionality thesis. If you are holding Tilray because you think they're about to launch a nationwide THC seltzer in Texas and Florida next month, you are betting on a strategy that just became federally illegal. This disconnect between the beverage hype and the legislative ban is why the stock is struggling to hold momentum, even on a green day. We need to talk about the beverage giant narrative, because this is the shield Tilray uses to deflect from its cannabis struggles. CEO Irwin Simon has been aggressive, almost frantic in acquiring craft beer brands. From Shock Top to Breckenridge, Tilray is now arguably a craft beer conglomerate that grows weed on the side. If you use a SoFi Invest account or track sectors via Fidelity Investments, you might see Tilray classified increasingly alongside Molson Coors rather than Canopy Growth. The expectation is that this diversification makes them safe. If pot fails, they still sell beer. It sounds logical. But the reality of the craft beer market in 2025 is grim. We are seeing sober curiosity trends, declining alcohol consumption among Gen Z, and massive margin compression due to rising costs of aluminum and hops. Tilray didn't just buy revenue, they bought into a declining industry to mask the decline of another industry. They are trying to staple two struggling businesses together to create one healthy one. The Q1 earnings showed strong growth in beverages, sure, but was it organic or was it just buying revenue? The market is starting to suspect the latter. When you peel back the layers of the earnings report, you see that while the top-line revenue number looks big, the organic growth, selling more beer to the same people, is flatlining. This is the reality check that is keeping a lid on the stock price at $7.32. Now let's look at the international angle, specifically Germany. Germany legalized recreational possession and cultivation, and the expectation was that this would trigger a green wave across Europe, with Tilray's massive German facility leading the charge. Investors expected a windfall of sales immediately. The reality of the German rollout has been agonizingly bureaucratic. It's legal, but the commercial sales model is highly restricted to social clubs and nonprofit structures. There isn't a dispensary on every corner model like we see in Canada or Colorado. Tilray is well positioned for the medical market there, which is expanding, but the recreational bonanza hasn't materialized in the P&L statement yet. The stock price today reflects this disappointment. The German premium that was priced into the stock earlier in the year has evaporated, leaving us with the cold, hard numbers of medical exports, which are good, but not enough to justify a multi-billion-dollar valuation on their own. I want to pause here and ask you guys a question, because this hemp loophole closing is a huge deal that not enough people are talking about. Comment below. Do you think the ban on hemp-derived THC drinks is the final nail in the coffin for U.S. expansion, or will companies like Tilray find a new workaround? I'm genuinely curious if you are holding the stock for the U.S. potential or the Canadian/German operations. Moving back to the technicals on the chart, the $7 level is the new line in the sand. Post-split technical analysis gets messy because all the historical moving averages have to be recalculated. The algorithms trading on platforms like Robinhood stock trading or Interactive Brokers trading platforms are resetting their baselines. What we are seeing today, the bounce off $7, suggests that there is some support here, likely from short covering. Short sellers who rode the stock down from the pre-split equivalent of $10 are taking profits. But where are the new buyers? To sustain a rally, you need fresh capital. You need institutional accumulation. And right now, the data from Fidelity mutual funds and other institutional trackers shows a net outflow. The big money is using this liquidity event, the split and the volume, to get out, not to get in. They are selling the news of the restructuring. This creates a massive overhead supply. Every time the stock tries to push to $7.50 or $8, it runs into a wall of sell orders from funds that have been trapped in this trade for years and just want to salvage what is left of their capital. Let's dig deeper into the cannabis holiday gift guide news that dropped recently. It feels like a standard PR move, but it highlights the company's desperation to energize the retail base. They are pushing seasonal sips and holiday bundles. The expectation is that Q4, the holiday quarter, will be a blowout. But the reality is that the Canadian cannabis market is saturated. Price compression in Canada is relentless. You can buy high-quality flower in Ontario for prices that were unimaginable 3 years ago. This is great for consumers, but terrible for producers. Tilray has to sell twice as much weed to make the same revenue they made in 2021. This race to the bottom on pricing is destroying margins. While they are the market leader in Canada by market share, being the king of a shrinking margin kingdom is a precarious position. The gift guide is a nice marketing fluff piece, but unless those gifts are being sold at a gross margin above 30%, it's not helping the bottom line. If you are an individual investor, perhaps doing some online investing or self-investing for your retirement, you need to look at the goodwill on the balance sheet. Tilray has made so many acquisitions, Afria, Hexo, the beer brands, that their balance sheet is bloated with intangible assets. The risk here is a massive write-down. If the auditors decide that the brands they bought are worth less than they paid, which is highly likely given the market decline, Tilray will have to take a non-cash impairment charge. This doesn't burn cash, but it destroys earnings per share and signals to the market that management overpaid. We saw this happen with other cannabis giants, and the stock price usually collapses in response. At $7.32, the market is pricing in some risk of this, but arguably not enough. We also have to consider the insider ownership factor. In the past, we've seen management receive generous compensation packages even while the stock plummeted. This has created a rift between the boardroom